Hi, I'm Rick Kaler, and thanks for joining me. Well, in story after story, the financial press proclaimed the first decade of this century as an investment disaster, a lost decade, they've said. Well, that is true if your investments were primarily in U.S. stocks. According to a Wall Street Journal report, which was from December 22nd of last year, 2009, since the end of 1999, stocks traded on the New York Stock Exchange have lost an average of 0.5% a year. Now that makes the last 10 years the worst calendar decade for stocks going back to the 1820s. Yes, it's even worse than the 0.2% decline suffered by stocks during the Depression years of the 1930s. The journal quotes Michelle Gambria, chief economics at Ibbotson Associates, as saying the last 10 years have been a nightmare, really poor for U.S. stocks. However, smart investors know that it's really just folly to invest in just one or two asset classes like U.S. stocks and U.S. bonds. The problem with doing this is that your fortunes are going to totally rise or fall in direct proportion to their performance. The last 10 years were certainly not good to U.S. stocks. Now, had you been invested in the decade of the 80s in stocks or the 90s, the opposite was true. So what you haven't read in much of the financial press was that not every asset class had a bad decade. For example, real estate investment trusts increased around 9% annually during the last decade. Natural resources returned around 5%. U.S. bonds gained about 6% a year. Pacific Rim countries, their stock markets, notably China, had an excellent decade. So investors who allocated a static portion of their portfolios to each of these other 9 or 10 asset classes and rebalanced periodically earned 4 to 8% on an annual basis over the last 10 years. Now that's hardly a lost decade. You might compare building a good portfolio to the inner workings of the V8 engine. The goal of the V8 engine is there's one piston firing and one in recline with 6 in between all the time that move the vehicle forward. And so with an investment portfolio, it's much the same. Those 8 investment classes, over a long period of time, you want 8 investment classes that are going to produce, say, a 5 to 9% return. Now in any one year, one of those asset classes is firing and doing really well, and one is in total decline and doing poorly, and the other 6 are somewhere in between. This action keeps the portfolio more stable, less volatile, while producing solid returns over the long haul. Now, a major key to the success of this strategy is that during time of emotional rationality, that's when you want to be setting the percentages that you're going to invest in each asset class, which in my example would be the pistons. You then periodically rebalance. For example, if your target on one asset class is 10% and it goes to 12, you sell that, bringing it back down to 10, and you put that money in an asset class that's gone down, say from 10 to 8%, you bring that back up to 10%. Now, investors who followed this strategy saw their portfolios lose less than 10% since the end of 2007. So actually, portfolios are still near their all-time high that was reached, let's say, at the end of 2007. Now, investors who panicked during the market bottom in March of 2009 and lightened up on stocks actually increased their losses since the end of 2007 to 25 to 40% rather than 10. Now, what I am finding in a normal year, the returns garnered by my clients typically lie within a tight range. That just was not the case in 2009, where I saw returns range from a minus 8% to a positive 36% and everything in between. Most of my clients' portfolios' annual returns were directly tied to how much they reacted out of fear and sold equities near the market bottom in March. Now, those who stayed the course saw their portfolios rise an average of 30%. And I would say that would be in a portfolio that was 70% invested in owning things and 30% invested in bonds and cash-like investments. But those who got scared and reduced their exposure to stocks during the first quarter of 2009 shaved 10% off their annual return for 2009 for every 10% reduction in equities. For example, an investor who had 70% in stocks going into 2009 and reduced it in March to 50% probably reduced the total return from 30 to 10, costing themselves 20%. On $1 million, that's $200,000. Now, if that same investor was unfortunate enough to reduce their stocks from 70% to 30%, they actually lost 10% on the year rather than have a return of 30%. It's a 40% swing again on $1 million. That was $400,000. That hurts. So the lesson, and the lesson that I'm taking from this past decade, is a classic one. While a diversified portfolio, diversified amongst asset classes, will never hit a home run, neither will it ever strike out every time it bats. Thanks for joining me.